Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
First Energy is a regulated electric utility in Akron, Ohio. Formed in 1996 from the merger of Ohio Edison and the Illuminating Company, it expanded to 5 states through the 2001 GPU acquisition.
That footprint, Ohio, Pennsylvania, New Jersey, West Virginia, and Maryland, serves 6 million customers across 65,000 miles of transmission and distribution grid infrastructure.
The business is almost entirely regulated. Distribution accounts for 78% of revenue, while regulated transmission provides the remaining 22% at higher allowed returns overall.
Transmission is the growth driver. The rate base expands at roughly 10% annually, funded by grid hardening investments that regulators require regardless of broader economic conditions.
First Energy went through a serious governance crisis in 2020. Executives were implicated in a $60 million bribery scheme linked to Ohio nuclear subsidies, and the stock dropped nearly in half.
The response was a complete leadership reset. Brian Tierney became CEO in 2023, arriving from JP Morgan's infrastructure advisory practice, an external hire signaling a clean break from prior management.
By 2023, the regulatory cleanup was largely complete. First Energy settled with the Department of Justice, reformed its lobbying, and re-engaged 5 state commissions with a straightforward capital story.
The dividend was cut in 2021 during restructuring, falling from $1.56 annually to $1.24. It has been rebuilt steadily since, returning to the pre-scandal level of $1.56 by 2024.
First Energy competes for investor dollars alongside AEP, Duke Energy, and PPL. The differentiation is a higher transmission growth rate combined with a post-scandal valuation discount that persists.
Dividend coverage sits around 2 times earnings, a reasonable buffer, especially given the company's recent history of cutting its payout when financial and legal pressures mounted.
First Energy competes for investors alongside AEP, Duke Energy, and PPL. The differentiation is a higher transmission growth rate combined with a post-scandal discount the stock has not fully erased.
Dividend coverage sits around 2 times earnings, a reasonable buffer, especially given the company's recent history of cutting its payout when legal and financial pressures mounted simultaneously.
The long-term thesis is straightforward. Mandatory infrastructure investment, a monopoly franchise across 5 states, and a management team rebuilding regulatory credibility one filing at a time.
The rebuilding story is still in progress, but the fundamental utility economics, regulated returns, growing rate base, and recovering dividend are intact and improving with each rate cycle.
First Energy's size, 65,000 miles of lines serving 6 million accounts, means even small improvements in regulatory relationships translate into meaningful long-term earnings uplift.
The rebuilding story is still in progress, but the fundamental utility economics, regulated returns, growing rate base, and recovering dividend are intact and improving with each passing rate cycle.
That's the company chapter for First Energy. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Welcome to Charged Alpha. I'm Hudson, and today we're covering First Energy, ticker FE, the regulated electric utility serving the Midwest and Mid-Atlantic. Market cap around $27.1 billion. Q1 2026 EPS came in at 72 cents, right in line with the 72-cent estimate. No beat, no miss, exactly on target. Revenue landed at $3.8 billion. First Energy is a utility story with layers. On the surface, it's straightforward. Regulated electric distribution and transmission across Ohio, Pennsylvania, West Virginia, New Jersey, and Maryland. But underneath, there's a fascinating turnaround narrative. This company emerged from a significant governance crisis, a $60 million bribery scandal settlement finalized in the 2020 to 2023 timeframe, and is now executing a clean slate rebuilding effort under new leadership. The capital plan is massive, the load growth outlook is improving, and the regulatory relationships are being painstakingly restored. Lana, set the scene.
FirstEnergy's story is one of the more compelling utility turnarounds in the sector. The bribery scandal, involving Ohio House Bill 6, a nuclear plant bailout that FirstEnergy secretly funded through a political slush fund, was a low point for corporate governance in the utility industry. The company paid $60 million in a deferred prosecution agreement, replaced most of its senior leadership, and has been systematically rebuilding trust with regulators in Ohio, Pennsylvania, and its other jurisdictions. That governance reset is now largely complete. The new CEO and management team have refocused the company on what regulated utilities do best: investing capital in the transmission and distribution grid and recovering that investment through the rate base process. FirstEnergy's footprint covers approximately 6 million customers across 5 states, making it one of the largest regulated electric utilities in the United States. The transmission business, which serves as a high-return federally regulated segment, is the core of the investment thesis going forward.
The Q1 numbers: revenue of $3.8 billion, EPS of 72 cents, bang in line with estimates. For a regulated utility, inline results are not a disappointment. They are the expectation. Utility earnings are by design highly predictable. The regulatory compact ensures that the company earns an allowed return on its rate base, and as long as management is executing on the capital plan and maintaining constructive regulatory relationships, EPS should track within the guidance range. What makes FirstEnergy interesting is not Q1, it's the next 3 to 5 years. The company has committed to a capital investment plan exceeding $26 billion through 2028, heavily weighted toward transmission upgrades and grid hardening. That capital goes into the rate base, earns a regulated return, and translates directly into earnings growth. The earnings growth rate coming out of a period of regulatory uncertainty and post-scandal rebuilding can be attractive if execution is clean.
The income statement context for a regulated utility like FirstEnergy is fundamentally different from an industrial or technology company. Revenue is largely a function of rate-based recovery, allowed return on equity, and throughput volumes. Operating expenses are managed within the regulatory framework. The 72-cent Q1 EPS reflects normal seasonal patterns. The first quarter tends to be strong for Midwest utilities due to heating demand, which drives electric consumption in an electrified heating market. What analysts are watching on the income statement is not so much the top-line variability, but the trajectory of rate-base growth and the successful recovery of capital through the regulatory process. Pending rate cases in Ohio and Pennsylvania are the key income statement catalysts. If FirstEnergy can secure constructive rate outcomes, allowed returns in the 9 to 10% range on equity, the earnings growth algorithm is straightforward: invest capital, file rates, earn the return, grow EPS. The math is simple. The execution requires sustained regulatory goodwill.
The moat in regulated utilities is unique. It's geographic exclusivity granted by government franchise. FirstEnergy is the only authorized provider of wired electric distribution in its service territories. There is no competitor who can string wires alongside FirstEnergy's and compete for the same customers. That regulatory monopoly is the foundation of the business model. The return is not spectacular. Regulated returns on equity typically range from 9 to 10.5%, but it is predictable and inflation adjusting through the rate case process. The transmission segment benefits from Federal Energy Regulatory Commission oversight, which tends to allow slightly higher returns than state-level distribution regulation. FERC-approved returns on transmission have historically been in the 10 to 11% range. FirstEnergy's transmission-heavy capital deployment strategy is deliberately targeting the higher return, federally regulated segment of the business. That's a smart capital allocation choice that improves the quality of the earnings base over time.
Cash flow for FirstEnergy tells the story of a utility in heavy reinvestment mode. The $26 billion capital plan through 2028 means capital expenditures are running at elevated levels, several $billion per year. That CapEx is funded through a combination of operating cash flow, debt issuance, and equity. The leverage at FirstEnergy is a concern. The balance sheet carries significant debt, which is not unusual for a capital-intensive regulated utility, but it limits financial flexibility. The dividend yield of approximately 4.2% is meaningful for income-oriented investors. FirstEnergy had to cut the dividend during the scandal period, and the recovery of dividend growth as earnings grow is a positive signal for management's confidence in the earnings trajectory. Free cash flow after CapEx is negative in heavy investment periods. That is expected and normal for a utility growing its rate base aggressively. The key metric to watch is not short-term free cash flow, but the pace of rate base growth and the regulatory recovery of that investment.
Capital allocation at FirstEnergy is essentially synonymous with the capital plan. $26 billion of identified investment through 2028, primarily in transmission infrastructure, grid hardening, smart meters, and distribution system upgrades. This is not growth by acquisition spending. It's organic investment in the regulated asset base that earns a predictable return. The strategic priority is clear. Invest in federally regulated transmission, which earns FERC-approved returns, and recover distribution investment through state rate cases in Ohio, Pennsylvania, West Virginia, New Jersey, and Maryland. The dividend is being maintained and is positioned to grow modestly in line with earnings. The company is not in a position to aggressively buy back stock given the capital needs of the investment program and the elevated leverage. The priority is balance sheet strengthening alongside capital deployment, a balancing act that management is navigating carefully as regulatory relationships continue to rebuild.
The catalyst landscape for FirstEnergy is actually quite rich for a utility. Catalyst 1: load growth from data centers and manufacturing. Ohio and Pennsylvania are emerging as significant data center markets given their land availability, power infrastructure, and fiber connectivity. Data centers are extraordinarily electricity-intensive customers, and new data center connections add immediate load growth to the rate-based mathematics. Manufacturing reshoring. Driven by federal incentives for domestic semiconductor and battery production, is a similar story. When a large factory connects to the FirstEnergy grid, it is multi-megawatts of additional throughput. Catalyst 2: successful rate case outcomes in Ohio and Pennsylvania. These two states represent the bulk of FirstEnergy's customer base. Constructive outcomes, meaning allowed returns that let management recover the capital plan costs, are the most direct earnings catalyst. Catalyst 3: balance sheet deleveraging and credit rating improvement. As the company earns its way through the capital cycle and rebuilds creditor confidence, lower financing costs flow directly to the bottom line.
Analyst sentiment on FirstEnergy is roughly centered on hold, with a consensus price target around $46 against the current price of approximately $43. That's about 7% upside to the target, which is consistent with what you'd expect for a utility in rebuilding mode. Not priced for perfection, not priced at a distressed multiple. The more constructive analysts on the stock are focused on the load growth opportunity, the clarity of the capital plan, and the belief that the regulatory relationships are genuinely improving. They argue the post-scandal overhang is creating a persistent discount that doesn't reflect the fundamental improvement in the business. More cautious analysts focus on the Ohio Public Service Commission relationship. Ohio regulators remain more skeptical of FirstEnergy than peers following the HB6 scandal, and on the execution risk embedded in a $26 billion capital plan. Utilities with large capital programs and constructive regulatory relationships have historically been excellent long-term compounders. The question is whether FirstEnergy has fully earned the constructive regulatory relationship it needs.
Valuation on FirstEnergy is interesting relative to utility peers. Regulated utilities typically trade between 15 and 20 times earnings, with the premium or discount relative to the peer group reflecting the quality of the regulatory relationship, the growth rate of the rate base, and balance sheet health. FirstEnergy's discount to the high-end utility valuation reflects the lingering post-scandal risk premium, the elevated leverage, and the ongoing execution risk of the capital plan. At roughly 15 times forward earnings, the stock is not cheap on an absolute basis. Utilities rarely are in an elevated rate environment, but it appears cheap relative to better-positioned utility peers, trading at 18 to 20 times. the $42 to $43 range has established itself as a floor with the dividend yield providing income support. The path to 46 and beyond requires demonstrable progress on rate cases, continued load growth, and balance sheet improvement. The risk-reward from current levels is skewed to the upside if regulatory normalization continues on the trajectory management has outlined.
Bull case 1. The data center and manufacturing load growth story is more powerful than the market is pricing. FirstEnergy's territory in Ohio and Pennsylvania sits in the middle of one of the largest electricity infrastructure build-outs in the country. Ohio has attracted significant data center investment. Amazon, Google, and Microsoft all have large facilities in the state or are developing them. Pennsylvania is similarly positioned. When a hyperscaler builds a 200-megawatt data center campus in FirstEnergy territory, that customer represents hundreds of millions of dollars of new electricity sales over a long contract horizon. Load growth of this magnitude, driven by secular technology infrastructure investment rather than traditional economic cycles, changes the growth algorithm for a utility. More kilowatt hours sold means more revenue to recover costs over, which improves rate case economics and can reduce the per-customer cost of the capital plan recovery. The electric vehicle transition adds a further layer of long-term load growth as vehicle charging becomes a meaningful part of the residential and commercial load profile.
Bull case 2. The governance reset is more complete than the market acknowledges, and the regulatory overhang is lifting. The HB6 scandal was severe, but the remediation has been systematic. FirstEnergy replaced essentially the entire C-suite, implemented a comprehensive compliance overhaul, and has operated without any major new regulatory controversy for several years. The deferred prosecution agreement has been resolved. The Ohio Public Service Commission, while still appropriately cautious, has been engaging with FirstEnergy on rate matters in ways that suggest the relationship is stabilizing. In Pennsylvania, Maryland, New Jersey, and West Virginia, the regulatory relationships were less damaged by the Ohio scandal and have been more straightforwardly constructive. As more rate cases are decided and demonstrate that regulators are allowing fair recovery of the capital plan, the scandal risk premium embedded in the stock price should continue to fade. Investors who can look past the historical headline and evaluate the current business quality may find the post-scandal discount represents a genuine entry point.
Bull case 3. The $26 billion capital plan creates a visible and compelling earnings growth path. This is the most mechanical bull case for a regulated utility investor. When a utility commits to a multi-year capital plan of this scale, and when regulators allow fair recovery of that investment, the earnings growth rate is essentially deterministic. $26 billion of new rate-base investment over 3+ years, earning regulated returns in the 9 to 10.5% range, translates into substantial earnings growth relative to the current earnings base. For context, FirstEnergy's current market cap is $27 billion. The capital plan represents nearly a full company's worth of new investment going into the rate base. If that capital earns even a 9% regulated return and rates are set to recover it, the incremental earnings contribution is enormous. The market is discounting that growth at a higher than peer risk premium because of the scandal history. As the risk premium normalizes, the stock should re-rate meaningfully higher.
Bear case 1. The Ohio regulatory relationship is not as repaired as management suggests. This is the central bear argument for FirstEnergy. Ohio represents a large share of the company's customer base, and the Ohio Public Service Commission's relationship with FirstEnergy was severely damaged by HB6. Ohio regulators have political incentives to be tough on FirstEnergy. Voters are aware of the scandal, and any perception that the PSC is too friendly to the company creates political risk for commissioners. A tough Ohio rate case outcome, where regulators disallow significant portions of the capital plan recovery or set allowed returns below what the capital plan requires, would directly impair the earnings growth algorithm. If the Ohio relationship requires several more years to normalize before constructive rate outcomes are achievable, the earnings growth timeline extends, and at current interest rates, that extension has a meaningful present value cost for shareholders.
Bear case 2. High leverage constrains financial flexibility in an elevated rate environment. FirstEnergy's balance sheet carries substantial debt, which is not unusual for a capital-intensive regulated utility, but the leverage ratio is at the higher end of the investment-grade utility peer group. In an environment where interest rates remain elevated, the cost of refinancing maturing debt and issuing new debt to fund the capital plan is meaningful. Higher financing costs flow directly through to earnings. Each incremental 100 basis points of interest expense on $26 billion of capital is a significant number. If credit markets tighten, or if FirstEnergy's credit spread widens due to any regulatory setback, the cost of the capital program increases, compressing the return spread between what the utility earns on rate base and what it pays to fund that rate base. The combination of high leverage, an enormous capital program, and an imperfect regulatory relationship creates a scenario where execution must be nearly flawless to deliver the earnings growth embedded in the bull case. Any slippage in regulatory recovery or financing costs creates downside to consensus estimates.
Bottom line on FirstEnergy. This is a regulated utility in the middle of a credible turnaround, with a massive capital plan that creates visible earnings growth potential and a dividend yield of 4.2% that provides income support while you wait for the thesis to play out. The governance reset is largely complete. Load growth from data centers and manufacturing is a genuine tailwind, and the regulatory relationships are improving. Though Ohio remains the key watch item, the Q1 inline result confirms execution stability. The stock at $43 with a consensus target of $46 is not pricing in a dramatic re-rating, but the risk-reward skews favorably for patient income-oriented investors who believe the post-scandal risk premium continues to compress. The bear cases around Ohio regulatory friction and leverage are legitimate. This is not a zero-risk utility. But for investors seeking a 4% plus yield with above-average earnings growth potential from the capital plan cycle, FirstEnergy warrants a serious look at current prices. Financial data sourced from Financial Modeling Prep. Charged Alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.